Mahantesh, good morning.
Morning.
Suddenly the risk off that we have seen in the last few days, do you think it's something similar to the Jan 2016 event?
Seems similar because even then at that point in time it was global markets linked trend, so we can seeing similar thing happening. In fact, post that February, when Jan-February, when the entire rally that we have seen in the market is quite frankly not fundamentally supported. We have had another quarter of results to mull over, and therefore I'm telling you that it's not so fundamentally supported. It's liquidity driven, and the support is coming from the huge inflows on the FII side. So therefore, when we look at the current weakness in the market, it's again global cues linked.
And you think it will continue? Yields have started to go up, dollar index has again started to go up, so maybe that liquidity is trying?
Yes, because what is also happening is that there is this impending fear. We all know that Fed is bound to raise their interest rates now. Whether they're going to do it now in September or whether they're going to do it in December, the opinion is divided. But having said that, this is too short a period now for the markets to really ignore September or December. Irrespective of the period, the rates are going to rise. So therefore, the cautiousness in the global markets is being seen, and there will be a gradual pullout of liquidity. So it's but natural to expect the dollar index to go up.
Don't you think markets are already prepared? When they started last December about this rate hike, they had plotted 4 rate hikes going ahead in a year. As of now, nothing has happened. The consensus continues to estimate that December would be the next rate hike. Don't you think markets are already prepared for it?
The markets are prepared for it, but then what we really don't know is that how swiftly and how fast the rate hikes are going to be. Around the same time last year, and actually August of last year, we saw the markets correct because of the impending rate hikes, and we had Janet Yellen also talking about the inter-calendar year 16 to be characterized by interest rates rising all the way to 2.25%, but that never really happened. Now the Fed is trying to hint and say that the next calendar year, which is 2017, the interest rates hike would be all the way to 3.5%, if I'm right. So that's going to be far steeper than what was expected in 2016. 2016, as the year is closing, we are already in September, we find that there's been virtually no rate increase that has happened. If at all, whatever is going to happen is going to happen now in September or maybe in December. So that quantum is very small. So the Fed's talk to calm the markets or give direction to the markets has not succeeded in 2016. Probably is not going to succeed in 2017 either. Therefore, the actual action of rate increase is what will matter, and therefore, whenever those events come up, we will see far sharper falls.
As far as earnings are concerned, Q1 earnings were decent, but you don't expect them to materially pick up from here on?
No, in fact, on a broader basis, the earnings were actually down over the year ago period. And that's thanks to some of the larger names and larger sectors, such as the BFSI and the oil-linked companies, sort of not reporting robust earnings. So having said that, the clutch of all the companies in the universe has actually shown a degrowth in earnings. So it's very difficult to say that the quarter was decent. I've alluded to the fact that the entire rally in the market post February seemed to be not supported by any fundamental earnings trajectory improvement.
As far as Nifty levels are concerned, what would you characterize this correction as? A correction in a bull market, or we are seeing a change of trend?
I think we're going to see a change in trend. So unlike in the past where there are quick short corrections and thereafter similar bounces, this is going to be an elongated trend correction, trend reversal, where valuations will start easing over the years. So we're going to see possibly a gradual fall in the market, or even if the market doesn't really fall, we will see a time-based correction setting in now.
And what would be your top picks? BFSI, you mentioned numbers were not that great, but would be the top pick? Have the numbers bottomed out?
Actually, yes, that's exactly what we've been looking for. We've been bullish on the BFSI space on two counts. One is that this is going to be the year of resolution. There have been a lot of NPA issues. The AQR process initiated by RBI way back in October last year has completed its course, I would say, and therefore this is the year of resolution. We will see a lot of recoveries coming up in the banking space. Last 3 years, the other trend that we are noticing in the BFSI space is that in the last 3 years, the credit growth has been in single digits, and therefore the banks had nothing much to really look forward to. Now we're going to see a substantial credit growth also coming up. That makes us positive, and along the way, if there are good, strong capitalized, well-capitalized banks, then we should be looking at that space.
Right. Among your top picks is Bank of Baroda. Within the PSU bank, this would be one of the most expensive bank. What's the reason for Bank of Baroda as a top pick?
There are 2-3 things you can quickly notice. That it has a strong capital adequacy ratio. The TYRE 1, if I'm right, is 10.5%, 10.7% thereabouts. So it is pretty strong. Yes, on a relative scale, the valuation appears expensive, but then it is still just about 1 times its book, or slightly lower than 1 times its book. And there is huge amount of growth to look forward to. The first quarter results were not so great because the slippages increased, but there was a recovery as well. So we saw that process of recoveries coming in. So they will go through that phase of resolution. I think they will emerge as a stronger bank in the years ahead.
Bank of Baroda, we spoke to them after results. The management was very clear they don't need capital for further growth. Is that a positive?
That should be termed positive because if you're well capitalized and if the economy is poised for growth, more than the economy, we are saying that the credit growth will set in. If that is the case, then banks like Bank of Baroda will be the first first off the block in terms of the growth.
We saw Yes Bank with the QIP, and they had to finally pull off. Isn't that a negative for the sector as well, that the appetite in the sector is very, very limited?
No, we don't see that as negative. In fact, there was considerable demand that had come in, of course, for extraneous reasons linked to pricing, etc. The issue was called off by the management. But then I disagree with the view that says that there was no appetite. There was appetite.
And so it should not be taken in as negative for the sector?
No, it is not negative. There is appetite. It's just that the valuations don't match. The valuation gap wasn't bridged, which will be the case even going forward for most other banks. So what I'm essentially trying to say is that with the overall market actually correcting, banks will also correct, but on a relative scale, you will have the banks growing in terms of their valuations, and therefore the appetite being matched to the expectations.
IndusInd Bank is also among one of your top picks. How do you get the confidence of valuation comfort over there?
So these are, like yes, IndusInd is also a very fast growing bank. And the comfort comes from that the consistent delivery that the company is able to deliver, even in the past 3 years of low economic activity, makes us confident that the management quality is very good. If the balance sheet health is strong, then companies like an IndusInd Bank will continue to sort of receive premium valuations over other peers.
So it's a buy despite high valuation?
It remains a buy, yes.
INFOSYS is also among one of your calls. We have discussed it earlier, But Infosys, what would you look at? Last 2-3 days in a volatile environment, Infosys has done well.
No, I think the last 2-3 days phenomena, let me answer that question first. The last 2-3 day phenomena seem to be the case that when markets turn choppy and they become choppier on the way down, people go to safe haven kind of stock. So Infosys is among the safe haven kind of stock. Irrespective of the challenges in terms of growth, irrespective of the guidance softening ahead, I think Infosys is at least offers great valuation, because it is now trading possibly like what 14 times its forward earnings. So by that metric, it's relatively cheap. It's cheaper than even the market, the broader market. Such a bellwether stock trading at cheaper multiple relative to the market makes it suitable for whenever these corrections happen. And moreover, except for this period, the post-Brexit period and the impending US election period uncertainties that we have witnessed, we see these companies actually emerge stronger as we go forward. So therefore, Infosys is a buy for us.
Right, but the growth over there is also slowing down. That's why lower multiples should not be the only reason to buy.
No, I agree. Lower multiples shouldn't be the only reason to buy. Therefore, I stressed upon the point that here is an example of a company which is cheaper, even relative to the sectoral valuation, the broader index valuation, and therefore, when you have such a strong company there, when growth challenges come up, companies like an Infosys with a huge cash reservoir of their own can make useful acquisitions along the way. So there can be an inorganic growth. Essentially what I'm trying to say is organic growth may be a challenge, inorganic growth is not a challenge for Infosys, and therefore somewhere things will happen for such companies.
You know, Infosys generally not known for doing very aggressive acquisitions. Can dividend payout or buyback also be a trigger apart from acquisition, as in usage of the cash?
Yes, but I think what we have noticed with Infosys over the past so many years, neither of these options have been explored by them aggressively. Even in recent times, post Mr. Sikka's arrival, we have not seen Infosys follow such a conscious buyback and dividend payout kind of policy at all. What it is trying to do is actually strengthen its business and continue to grow. So by that logic, while some may attribute this as one of the weak points of Infosys, we don't necessarily see it that way.
Within the mid-cap space, any picks that you have? Of course, mid-cap index is at a high and difficult to find out, but any mid-cap names that you like? So
since we are talking stock specific, normally I wouldn't want to, but then we have as a house outstanding buys on such stock as a JK TYRE, and we also have a buy on Kalpataru Transmissions.
That's an interesting thing that you're pointing out, JK TYRE especially, because first of all, good morning, Mahantesh. This is Anindya from the Delhi studio. I recently what I did is that I took out the NSE Nifty 500 stocks and tried to look at their 1 year forward P based on the consensus estimates, and JK TYRE is down there. One of the few companies which looks like that it is worth buying simply on relative valuation basis. So I had been asking this question to several of our experts, and they say that, well, the market is giving it a low P because it deserves a low P. So JK TYRE or any of these several companies that still have appeared to be valued low, they deserve that. But in a market heated like this, is that true? Is that true that the P is going to be low because a company deserves to have that low P? Is the market currently discerning enough?
No, I don't know what you mean by whether the company deserves a low P. If you say that historically JK TYRE has always traded in a low P band, and then the answer is yes, it has historically traded close to that 4 times forward multiples for quite a quite a long time, I would say, possibly 7-8 years. Therefore, a JK Tyre, we have seen historically, has always been valued at a low P. There could be several reasons, and we are aware of some of the reasons. This is a company which has not been able to shrug off its debt. It's always remained a high debt, highly indebted company. Right. Its credit rating was always very poor, BB or lower. So that doesn't qualify it to be sort of investment grade. So therefore, a lot of skepticism. But then, from the very word that you use, does it deserve? Then we don't think it deserves those low valuations, simply because from a business perspective, JK Tyre is a high brand recall company. You go out there in the market, people swear by JK Tyre's brand. They have even topped quality surveys in customer satisfaction surveys in the past. They're the leaders in truck bus radials in the market. So all this is sort of not really known about the company. But unfortunately, they also belong to an industry which is very volatile in terms of its earnings, simply because they're exposed to huge volatility in commodity prices. Plus, there is competitive pressure. Chinese tires are increasingly getting dumped. Between the Indian players, they always compete on prices and so on and so forth. So, having laid out all these aspects, what we are really looking at from JK Tyre's perspective is that one of the issues that's plagued them over these years will get addressed. The high indebtedness is something that will get addressed as we move forward. Structurally, JK Tyre has moved from EBITDA margins somewhere around that 10% plus or minus levels to now 15% plus or minus a few basis points. So there is a structural shift that has happened in JK Tyre. One of the reasons for the structural shift is also the recent acquisition of Kesoram's unit in Haridwar. That has brought JK Tyre into the two-wheeler space. So I think there is a structural shift that is happening with the company. Traditional valuations are low, so we still continue to work with low valuation levels. But as they go forward, if the debt levels fall as we foresee, then I don't see any reason for the stock to get re-rated in the years ahead.
Because if one looks at, if I compare, let's say, just in terms of relative valuation, CEAT, MRF and JK Tyre, then JK on an FY18 basis right now has gained a little bit, maybe 5.5 times, but the others are 10 and 11. So almost people are paying double the current earnings or future earnings.
I think we should also be looking at the EV EBITDA multiple for JK Tyre and others. So there the valuation gap is not so apparent.
So if I look at something like the total net debt, which comes to about, let's say, about roughly 2,500 crore, when you say that they are going to be...
You need to add the debt for the Kesoram unit. That's another 1,500 crore.
Okay, so that's 4,000 crores of debt. When you say that they're going to be able to get out of that, what is the reason you're saying that? Is it simply because of the expansion in EBITDA as an operational income?
No, I think we pointed out some time back, and I think we discussed also that if you look at the first quarter results, and that was one quarter where the new unit started producing and the new unit's sales also happened. The company posted a cash profit of close to 200 crores for that one quarter. So if you extrapolate that, and we see no reason for the trend to remain the same, then here is a company which can do possibly 200 into 4, that is 800 crores of cash profits in the year, possibly lower because the commodity prices are rallying as we go ahead. Maybe it could be 700 crore. Something similar will get repeated in the following year. And so in 2 years or in 3 years, the company would have generated close to 2,000 crores of cash profits. Now, some portion of that profit will be used for capex, and some portion of that will be used to pay dividends, and the balance will be left to repay debt. So, if we assume that 60%, 70% of that will be retained for debt repayment, the company's debt will rapidly fall.
That brings me to a company which is not on your top picks, but I'm wondering whether you cover that at all. Hindustan Construction, HCC?
No, we don't cover HCC.
Are there any of these companies like Patel Engineering, HCC, or any of these infrastructure companies which are heavily indebted or are stuck in arbitration that you cover?
Yes, so we have these EPC contractors that we cover, an ITNL to an ASHOKA BUILDCON to an IRB. So these are the companies that we cover.
So ASHOKA BUILDCON, I guess, is balance sheet wise pretty okay, right?
Sorry?
ASHOKA BUILDCON doesn't seem to have a problem on its balance sheet.
No, none of them have a problem on the balance sheet, but the fundamental business is what? They own huge road assets. Yeah. Each one of them has a portfolio of somewhere that 10, 12 road projects under their belt. Some of them are under construction and a few of them are already constructed. The debt problem actually with all of them is residing in these whole assets. In the past, when they bid, many of these companies from a stock market perspective have suffered because they overbid on some of these road projects, the underlying cash flows not being so great. But then nobody takes away the fact that they have a huge amount of assets with them. The debt can be brought down as the asset sales kind of happens. Look at what ITNL has done with their Andhra Pradesh project. They have sold that road project out there. Yeah. So that's a mechanism for all of them to bring down their debt. Now there is another mechanism that regulations have now enabled them through the route of InvITs. So the cash flows being generated by the already functioning road projects will flow into the InvIT structure. That's another mechanism for them to bring down debt. So from a business perspective, I do understand that they are heavily indebted, but we are conscious of the fact that they are they own really priced assets. These assets are of longer duration. These are not like assets that need to be constructed again and again. They're like sitting on a 30-year-old asset right now. Sooner or later, they will be able to realize their worth.
I just wanted to discuss HCC. I know you don't cover it, but let's say a company like HCC, right, which has been under tremendous pressure in terms of debt and has not been able to execute some of its orders simply because it cannot even generate working capital. Although they say that we are very asset light and we don't need to take credit for working capital. But with this new order in the construction space, the new norms that have come in, 75% of arbitration to be given out, HCC is probably one of the biggest gainers, right? So are you likely to open coverage, initiate coverage on HCC?
No, we haven't thought about HCC as yet, but then the whole government's move of providing or releasing cash to all these EPC contractors works in their favor. So yes, we think that's positive. Not only that, along the banks who have also lent to this project through the SR4 mechanism will also be able to sort of restructure the debt for some of these companies. So all in all, I think there are positive moves that the government is making to lighten the burden on many of these kind of companies. HCC is something, sorry, we have not done our homework, but we are not covering it right now. We don't want to talk about it.
Can you give us some sneak previews on the companies that you have initiated coverage and haven't completed it, and therefore you can't give us a call, but you're starting to cover now?
No, that's something I cannot reveal right now.
All right. I was just trying my luck. Okay. Thank you so much for coming in, Mahantesh. Pleasure talking to you as usual.